Hi, everyone. I'm Shameran Abed. I'm the Executive Director of BRAC International, and I'm very pleased to welcome you to this Runway to Frugal Innovation Forum 2022. I'm very pleased to be joined today by Greta Bull, who is currently at the Gates Foundation, and I'll let Greta introduce herself in a second. But this is just an opportunity for us to have a very informal chat about the state of financial inclusion for women, and especially how we can do better through digitization and technology. So I'm really looking forward to this conversation. Greta, great to be with you today, and over to you.
Hello, Shameran. I guess good morning for me and good evening for you. It's a real pleasure to be here, and thanks for having me. I love these kinds of conversations. Just for people who don't know me, my name is Greta Bull. I'm currently the Director of Women's Economic Empowerment at the Bill and Melinda Gates Foundation. Prior to that, I worked for 6 years at CGAP, where I led a team that was basically looking at financial inclusion, and we made women central to that theory of change in the last couple of years. So I'm really proud to say that CGAP's putting women at the center of everything they're doing. And before that, I worked for the IFC and the World Bank in various capacities. So looking forward to this chat.
Great. And I think you should clarify that you were leading CGAP for those 6 years, not leading a team at CGAP. But yeah, great to have you here, Greta. And yeah, maybe we'll just kick it off by just talking about, from your point of view, how do you see the state of financial inclusion for women in 2022? We've talked about this in the past, and obviously, we've made progress, but the last few years have been difficult as well for the financial inclusion industry. And you've really been at the forefront of trying to keep the industry going and liquid and continue to serve women. In your previous role at CGAP, now you're obviously leading the Women's Economic Empowerment team at Gates. So where are we now, and where do you see us going in the next few years, and what do we need to do to get there?
Yeah, I think you've summarized it well in terms of we've made a lot of progress, but we're not there yet, right? So, I think if we think about it in terms of women's access to finance, I'd say it's not great. We all know the headline number. Despite really impressive progress on financial inclusion, we have had a gender gap in every single Findex that's been done. I'm hoping this year might be better, but that gender gap is stubbornly stuck at 9% across emerging markets. But I think we have to look beyond that. Let's face it, very, very basic measure of access to an account that the Findex measures. And when you dig a little bit deeper, the disparities run even deeper than that, right? So on nearly every measure, from saving money in a formal financial institution to access to credit to run a business to accessing funds in an emergency, women simply have less access than men. And beyond that, as the world goes increasingly digital, we even have gender gaps in access to mobile phones and mobile internet. So women just basically have less access than men, and that is a problem. Your second question, where I think we need to be is for everybody to have access to the financial services they need when they need them, and that those financial services are suitable to people's needs. And that they're provided on reasonable terms and with sufficient information so people know what they're actually getting into. And despite a lot of progress on financial inclusion in the last few years, I think we're still a really long way away from that future. And I think there are a few reasons why that's the case. First is, I think we've kind of, not we as a community, but I think the term financial inclusion has sort of got hijacked a little bit. So I hear people talk about financial inclusion, and it's quite clear that the poor do not feature in their vision of what financial inclusion is. And so we get very obsessed with fintech and all these new technology changes that talk about financial inclusion, but don't necessarily involve the poor. And there's a lot of money and attention going to some of those things. And I think we have to really turn it back to the poor. And I spent a lot of time at CGAP trying to make sure that the poor were really central in what we were doing. And sort of adjacent to that, I think as an industry, and this is speaking about our industry itself, I think we have to stop with the endless pursuit of silver bullets and recognize that providing financial services to poor people is hard, and that we're likely going to move forward in increments. Sometimes we'll have leaps, and those leaps will be bigger than others. But I think we have to acknowledge that there is no magic wand that's going to solve for financial inclusion overnight. frankly, some of the expectations and claims over the years have suggested that these innovations are going to make this easy. First of all, microcredit was going to solve poverty. Then it was payments. And then, the evidence base comes along and shows that while there is progress, none of these things is enough on its own. So if our goal is for everybody to have the access to the services they need when they need them, then we still have a lot of work to do. Some pieces are in place, but neither the breadth nor the quality of services is available to the poor right now. Second point, and I have three, so I'll get through them quickly. I think we've also got to get away from this idea that everything has to be commercially viable and wildly profitable. Sure, it's great if an intervention can wash its own face. And I think one of the benefits of microfinance is that it does that. It's a really cost-effective intervention. But if we rely purely on commercial models, we'll get where we are today in Africa with small MFIs that struggle to grow and markets that are flooded with lots of expensive consumer loans and people who get into trouble taking up those loans. And I think that's driven of commercial returns. And where that leads you is in a direction where, you're extracting value from poor people and transferring it to providers and their investors. Or, more likely, poor people just won't take up those services. So I think we have to get back into a space where we understand that sometimes subsidy or public-private partnerships are required, and that we shouldn't be seeing, commercial and state capital as these very different things. Commercial capital does a really important thing. It makes sure that we allocate funds to where they'll get the best return. But government capital helps us make sure that they're distributed equitably and to where there's greatest need. And we need to find solutions that sit somewhere in between those two things. If I take the case, for example, of community development finance institutions or CDFIs here in the US, those are banking institutions that are designed to serve low-income and marginalized populations. They receive support from the U.S. government and access to wholesale funding on, relatively cheap terms. And so, I think there's something around revisiting what we're trying to do, which is solve a problem that's hard for poor people, and think about using all of the resources that we have at our disposal to be able to do that. And finally, this is my last point, and this is so obvious and yet so important. We have to make sure that financial services play a useful role in real people's lives, right? No one ever woke up in the morning thinking, I really need insurance, or I really wish I had a bank account. People get insurance or a loan or an account for a reason. And that reason is that product is relevant to their real lives. And unless we can connect financial services to solving real problems in poor people's lives, we'll continue to see low usage rates for these services. So, I'm a big consumer of things like the Findex and the GSMA State of the Industry report. And one of the things that just absolutely leapt out at me in this year's State of the Industry report was that, activity rates on mobile money accounts have hardly budged. They were at 20% on a 30-day basis in 2012, and that moved to 25% in 2022. And so what that tells me is that the MNOs have been really effective at signing people up for accounts. What they've been less effective at doing is providing a value proposition so that pace of usage actually happens faster than the pace of customer acquisition. Usage rates are still pretty dismal. 25% with 75% of accounts being dormant is not great. So I think we have to move away from this kind of overly simple access and usage paradigm into thinking about what financial services can do in people's lives. And so when I was at CGAP, the way we decided to focus our strategy was to do that. Finance for what? And we decided to focus it on three things: how you can use finance to generate income through livelihoods, how you can help poor people access essential services like electricity, clean water, education, and health through financial services, and safety nets. And I think that's a pretty good framework. It's what people need financial services to do for them, but we have to kind of get ourselves reoriented to, the original purpose of this industry, which was to help improve people's lives.
Yeah, I mean, I don't know what to say in addition to that. I mean, I feel very, very similarly on most of those things. I mean, on the first one, you started with the Findex and what it's measuring. And obviously, even the headline number, even though there's a long way to go, but it seems like there's a lot of progress being made, right? If from 14 to, when was it? The next one was, I think, 17 or something. And then, but if you dig deeper, it's number of people with accounts, and what they're using those accounts for are very widely. If you look at microfinance, most microfinance institutions still are credit only, right? And then it gets topped up a huge deal by mobile money accounts, and that's mostly being used for the ones that are actually active are only still being used for very specific things like transfer, like P2P transfers, right, from family members. So yeah, if you dig deeper, there's a long way to go on financial inclusion. So we were also discussing a few years ago through the Microfinance CEO Working Group, which then became the PRFI and the Microfinance Network, about how do we redefine the concept of financial inclusion and make it more about meaningful financial inclusion, which is much more than just having an account, right? And how do we get people to actually use these accounts to have the access to the products that you talked about: savings, credit, insurance, micro pensions, other things that people need, payments, and make it much more valuable, as you said, in terms of the role that financial services can play in people's lives and in women's lives, right? And then realize that the world is a very heterogeneous place, and needs are also different, and societies and cultures are different, right? So I look at financial services in Bangladesh with the microfinance industry being so large in this country, with giant MFIs like BRAC and Grameen and others, and many medium and smaller MFIs. So if you're a rural woman in Bangladesh, unless you're ultra poor, you will have access to, you probably can go and sign up to an MFI account and do the basics, put some savings into that account and get some, basic vanilla credit products, right? So in this market, it's at least some of that is available, more easily available, let's put it that way, than many other markets. But then we still have big concerns around, who's using the money and where's the money going, and are women becoming more channels for men to borrow because MFIs don't lend to men? And so the challenges are a bit different here, more around agency and use of credit and things like that. But then you go into India is probably similar in certain cases as well. But then you go to East and West Africa, and then it's the access isn't even there, right? You go to deep rural areas, and there's nobody there. There's no MFI there, and mobile money is out there in rural Kenya, rural Tanzania, but you're not going to be able to get a credit product through that. That helps you set up a business or do something, livelihoods or related, right? You can get maybe an emergency loan for a few days, but that's about it, right? So yeah, so there are lots of, it varies a lot between places as well of what you can do with it. And your second point, I couldn't agree more with. Of course, I come from an NGO background, so obviously I would say that I wish there was still a lot more subsidy in microfinance. I understand that microfinance should become viable, and at BRAC also we try to make all our microfinance entities viable and sustainable, and that is very much a big sort of objective of us doing microfinance. But when we're pricing products, we need to price them at a rate which makes them viable. And sometimes the delivery costs are so high and the costs of funds are so high that we're having to price them at rates which are also quite high. And we'd love to bring them down, but for that to happen, the delivery costs are going to need to go down, right? And the costs of funds are also going to need to go down. Luckily, we know how to do things, so we keep our costs of provisioning quite low, but the other two are beyond our, even that's beyond our control. But if you're good at it, you can reduce your loan loss provisioning, but the other two are not in your control. So yeah, how do we get financial services out there in more deep rural Africa, for example, and get access to women, get products to women, is still a big concern for us, even at BRAC, even though we have scaled in some markets. Because as we go more rural, the costs go up, and then it becomes difficult to do it in a viable way, at least for the first few years. So even if there was some support for the first few years of organizations setting up the distribution, and in the future, distribution doesn't have to be entirely brick and mortar, right? That was how it was in the past, And now obviously with mobile money and technology, it can be much more of a hybrid distribution. But I'm still of the opinion that you can't get rid of the branch network altogether. I mean, you still need that, and then build on top of that and go further with technology and with digitization, and reduce the costs of transactions, and reduce the cost of cash handling and all of that. But we're not ready anywhere to go fully digital, is what I've seen. And I knew, and there were a few years ago, I mean, almost 6 or 7 years ago, I was having conversations with some of your current colleagues, and they had already written of microfinance, and they were saying, this is the dinosaur in the room, right? This very expensive credit. And now with mobile money and all, we'll solve the problem in a different way. But I think what we're realizing over the last few years is microfinance wasn't the silver bullet, as you said. Mobile money isn't going to be the silver bullet. We're going to have to find ways to work together and figure out some of these problems, and really understand what the problems are, and what's stopping getting financial services out there in a meaningful way to women, and really figuring out how to do it together. And I think we're all trying to do that, but as you said, there's a long way to go. And finally, to your point about having these products be meaningful, and of course, I mean, financial services by themselves are nothing, right? And our view at BRAC is that even meaningful financial services will only get you so far, but then you have to have the things to buy with it. So you have to have access to education, you have to have access to healthcare, you have to have access to markets, and access to the things you need to be able to get your livelihoods started and going. So there's a lot of value chain work, there's a lot of market development work, there's a lot of all of the other essential services that also go with it to make financial services truly meaningful. So there is a lot. I'll add one more point to some of the things you talked about. And this is something that we've faced a lot, which is also pressure from regulators. I think, in terms of getting things out there, of course, we need the subsidies, we need better product development, we need more partnerships, but we also need regulators to understand how this works. We're seeing so much pressure to cap rates across many markets. We work in many markets where rates are already capped. Bangladesh, Myanmar, rates are already capped. In East Africa, several countries are thinking about capping rates or have capped rates. And I like to say, sometimes the road to hell is paved with good intentions, right? And I think the regulators want to bring down rates, which is the right idea, because rates are very high, as you mentioned, in many of these countries. But I don't think capping rates is the way to do it, because you're actually moving institutions away from the poor clients, and the poor are women. So if we're going to cap rates and get the institutions to start lending upmarket, where it tends to be more men, it's another systemic way to keep women out of financial services. So I think all of those things we need to really work on as well. But yeah, you're absolutely right. I mean, the situation right now for women is not good, and there's a lot of work to do. And even with the digital, there's a lot of very intentional work that we need to do to make sure that it doesn't actually widen the gender gap. Because if we just think that it's going to just go in and solve everything, and we don't intentionally, and I think a lot of the work you were doing at CGAP was about intentionally figuring out how do we build the ecosystem and the structures and things so that women can benefit from financial inclusion. And that's, I guess, a lot of what you're going to be doing in your new role. So that's great. But yeah, I think there's a lot that we need to work on. There's a long way to go.
Yeah, there is. There's a lot to unpack in what you've just said too, Shameran, and it speaks to some of the things that we're doing. So, I think there's one thing we have to kind of get away from, but also sort of figure out how to internalize is, this industry suffered from hype cycles for a long time, and we have to kind of move past the hype. None of this stuff is going to solve everything. It's really a complex set of problems, and it requires a complex set of solutions. But and what the hype does is it sort of says, oh, okay, microfinance didn't solve everything. That's garbage. Let's go to something else. And then all of a sudden interest in funding drops off, and it's going to be this thing now. And I was in a call about blockchain this morning, like, is this going to solve everything? And, we've got to stop doing that, because what we have to start doing is figuring out ways to make things work better. So we've undertaken an analysis getting at exactly some of the issues that you're looking at. The problem, regulators are not going to solve this problem by putting caps on interest rates. That will just literally dry up the microfinance industry. And what we saw in Kenya when they did it is that it turbocharged consumer lending, right? At even worse rates. We've got to get at the root causes. And I think you spoke to some of the root causes, right? The cost of wholesale funding in Africa is unbelievably expensive. FX hedging, super expensive and, unavailable in some places, right? The cost of getting out to rural areas is really difficult. And so I think we have to try to find ways of using public money to try to bring some of those costs down rather than putting caps on. So if I look at what India has done on things like priority sector lending, I think there's a lot to appreciate there. I'm not sure I would do it at 40% of my total banking sector. That's a lot. But gosh, we're actually not using banking systems to develop countries. We're using banking systems to lend to governments and to lend to big corporates. And that's not growing anybody's economy. So I think there's something in what they're doing. And we need to think of structures that can help bring down that cost of wholesale funding. But on the technology side, I do think the microfinance industry needs to take a long, hard look in the mirror too, because I don't think the microfinance industry has been that effective at adopting technology. And I think the industry does have to adopt technology into its practices precisely to bring down those costs. So I think a lot at the beginning when, we all started seeing what M-Pesa could do and the importance of payments was MFIs going, oh, I'm going to be the next M-Pesa, which was clearly ridiculous because MFIs don't do what M-Pesa does, right? And a payment system is really different than a financial institution. So I think MFIs need to kind of take a step back and go, how does this help augment my business? So, we're looking at things like, how you can do better data-driven decisioning. I mean, too many MFIs still can't do data-driven decisioning, even though they have good data. They can't do risk-based pricing. That's crazy. Like, how do you retain customers if you can't give them better terms and conditions as they prove what they can do over time? We've not done well enough on things like savings. And to me, savings are like fundamental. People should have access to savings and payments across the board. But the problem is nobody ever built a savings-led business model that works because you make money in financial services through credit, right? And so I think all these things have to be developed together. If we over-index on one service, payments, which is the latest one, then we're missing the boat on business models that incorporate credit responsibly that can then provide savings opportunities for people. And so, I think we have to look at this in a holistic way. And there's something around the funding, there's something around the regulatory environment, there's something about digitization and business models that's really important as we try to drive this industry forward. But to actually do that in a sensible way, we have got to leave behind this idea that, oh, microfinance was amazing and now it's garbage. That's just not true. It's a really valuable instrument. How do we make that instrument work better? And that's where I think we have to kind of take this conversation going forward as an industry.
Yeah, and I mean, just coming from the microfinance side, I think given that microfinance, went through about, a decade of everybody celebrating, right? And then, the year of microcredit, the Nobel Prize and everything. So, obviously, we had our day. And then it flipped entirely to the other extreme, right? And the last 10 years, it's like, oh, it doesn't work, it's rubbish, and it's gonna fall by the wayside, and we're gonna have to do things differently. But I think that's also created this sort of this siege mentality within the microfinance community, right? Where it's like, no, we've got to stay very true to our roots, and that's how we're going to prove our worth, because all of this is all very fancy stuff, but actually we've got to keep doing things very close to how we've been doing things. So, when I talk to microfinance colleagues, and honestly, I feel some of the same. I've felt some of the same tensions and worries, concerns as well. Once we start digitizing and things, what happens to the groups? What happens to group solidarity? What happens to all of, we used to say microfinance is supervised credit. So, and if you're not supervising it the same way, and your interaction is through a mobile phone and things like that, and you're not meeting your clients as regularly as you used to, and you don't know enough about them, any more than, so all of those things have come in, and, we haven't tried enough. We haven't pushed the boundary enough to see how things work. So we've just been talking about it for the last 6 or 7 years, but holding very close to our traditional group structures, right? Which is why you're absolutely right. I mean, given how long mobile money's been around, even for BRAC Microfinance, which has a very natural partner in bKash, right? Between the MFI and the mobile money company, or even between BRAC Bank, which owns the largest chunk of bKash, if you see how much we're trying to do together, it's still very much at the margins, right? And I think we'll come to the pandemic, but if it weren't for the pandemic, we wouldn't even be where we are right now, right? And that's sad. And we've got to hold up our hands and say that's problematic, right? And yeah, on savings as well. I mean, we've put a lot of focus on savings. I mean, historically, BRAC Microfinance in Bangladesh, was savings and credit. So it was with it. But, when we started doing microfinance in other countries, we were credit only because of regulatory needs. But then a few years ago, we decided to transform our Uganda one to a regulated tier 2 bank just so that we could take savings, right? That was the entire intention behind moving up a couple of tiers in the regulations. But boy, I mean, there are days where we question whether that was the right decision, because of course now we can offer savings, which is great, and our clients want to save with us. But now the regulatory problems that we're facing, the costs have gone up so tremendously, and we took a decision not to raise our pricing, right? Or move up markets. We want to stay where we are. And it's basically wiped out whatever margins we had, because just the costs of compliance. Because again, going back to regulators aren't writing regulations for MFIs and thinking about how do we serve low-income people. They're writing regulations for banks and then watering it down for MFIs. Yep. And it's the wrong starting point, and you're ending up with regulations that don't make any sense, right? I mean, some of the reporting that we need to do doesn't make any sense, but it is what it is.
Well, two things on what you just said that really resonated with me. I think one thing that the industry kind of suffers from, both on the provider side and on the regulatory side, is this kind of one-size-fits-all approach. Like, all microcredit borrowers are the same, so we're going to give them the same product, and we're just going to cookie cut that everywhere. And I think we actually have to think about this in a segmented way. I think group lending is really important for some clients and really appropriate for some clients, but some clients really should graduate from that and move into more individual lending products. Now, it's really hard to have an institution that does both of those things at the same time and takes deposits, and that requires a lot more sophistication. And so, I think we have to think hard about what that digital transformation looks like. But I can remember having this conversation with Finca 10 years ago when we were working with them on their agent banking strategy in the DRC, and we were kind of saying, if you start doing this to mobilize deposits, that is going to change your relationship with your client. You get that, right? It's going to be an individual relationship, and that's really different. And they really, to their credit, did think hard about that, and they tried to mix it in. And I think they make good use of that agent network now in the DRC. But we have to think about taking these technology innovations and absorbing them into microfinance models to make those better. But we also need to think about segmenting our clients, figuring out how we grow with our clients, thinking about how we can offer better products and services to them. And so I think there's still a lot of work to be done on that. On the regulatory side, I feel like I'm a broken record on this, but regulators need to have more nuance in the same way in the way they look at this. So I always go back to Peru, because I think Peru just has such a great regulatory framework, because it does that. It segments. And so, there's a whole step change process that you go through to become, you start as an NGO, you get licensed as an PYME, you get licensed as a financiera, and you go up the steps, and the compliance gets more complex as you go along. So you can grow and build out your systems and your capacities as you grow. And if you look at the Peruvian microfinance market, it's one of the most well-defined, sort of clearly delineated microfinance markets I've ever seen. So you've got the biggest banks running some of the bigger operations that tend more into the small business space, but they're still focused on individual microcredit clients, all the way down to NGOs that are operating in the Amazon jungles and doing group lending. Compartomos went into that market with a group product. Nobody thought a group product was going to work in Peru. Guess what? They've grown really quickly. And so, there's room for all those different kinds of things, and they should be supervised for what they are. And to Peru's credit, they actually have a special supervisory unit in the superintendency that does that, and they do it incredibly well. They also have the best data I've ever seen. So they can segment the market by loan size, by where it is, and so they have a lot of visibility into what's going on in their credit markets, and it means they can manage it a lot better than most markets. One size fits all in regulatory is not going to make any sense either.
No, absolutely. And, I mean, there are a few countries which have done that, created a separate regulator for microfinance or a separate division entirely. But then somehow, I mean, Peru is a good example, but even there, they sort of second staff from the central bank to that, and they come with this, and by the time they really understand the sector, they get sent back, and some new people come. So that's also been an issue that we have. But I wanted to say something about group lending. The more I think about it, I think group lending these days in most markets where microfinance has been around for many years is much more important for the provider than for the borrower, right? So, and I say that to a lot of my microfinance friends, and, we might not want to admit it, but actually, do our clients really need the groups anymore? They've been borrowing for years and years, and even this, and some are newer clients, but they're second, third generation clients. They've seen their parents and their grandparents borrow from MFI. So do they come to the groups and really talk about problems? No, they come, they do their transaction, they go, right? And it's the groups there, but it's really the transaction is very individualized these days. The old sort of model of everybody sits and does the promises and talks about what's going on. And I haven't seen that in many, many years, right? In definitely not in Bangladesh, but I don't even think in East Africa or even now in West Africa, where we work. So, that's much more important for the provider to keep distribution costs low, because you go to one spot and you got a lot of women and you can quickly do your transactions, you come out. And that's where, I've been saying maybe we don't need the groups anymore from that perspective, because, that we can easily digitize these days, right? So, who needs the groups more, and what does it? And, for an organization like BRAC, for example, where we don't even do joint liability anymore, right? Even liability is individualized, because that's also something that I feel holds, people back, right? Again, talking about, holding everybody back to the lowest common denominator.
Yeah.
In a joint liability group, if you're giving somebody $2,000 and somebody $200, you can't hold a $200 borrower liable for somebody you've given 10 times the loan. So you have to keep everybody at a low and push them up slowly and at the same rate, which we figured out long ago holds the best borrowers back. So there are a lot of structural issues as well that we need to work on from the provider side as well. But yeah, I mean, some of these things we need to really question and say, it's the time come to, reimagine how we do business, right? And figure out new business models that's more technology driven, but also with an eye to making sure that women are the intended, are the intended clientele, and we can get these services out to women cheaply and responsibly and quickly, which is basically hopefully what we're trying to do.
Well, and I think that's exactly the right question to ask. And I think I can't believe I'm going to defend groups, but I will maybe defend groups a little bit here. I mean, I do think we need to sort of give people products that are appropriate for what they need and to grow with them over time. That might mean starting people who have never had a loan before in a group context, because there's a lot you can do to learn and grow. And I think, there's some interesting things that are done with self-help groups and VSLAs and the like, where, you're kind of onboarding people to something. But if people are capable in a group and do things that way, if they could do it themselves, and with technology and data in particular, people can then take their credit history and take it with them and get better terms and conditions. And I think about the evidence base, the famous evidence base that has sort of been used to bash the microfinance industry over the head about how it doesn't work. That is not what that evidence base says. It doesn't say that it doesn't work. It says that it works really well for some people. It doesn't work so well for others, and for a bunch of people in the middle, it's kind of meh, and so what that tells you is you need to target better, to my mind. So we need to do a lot better targeting of services. So we're finding those people who can benefit from individual loans, who can benefit from bigger loans, who would benefit from risk-based pricing, and give them that credit history that they can take to get better services as they go. And I think that is where we've kind of fallen on our faces as the industry, because we sort of fall back to what we know and we can't touch the model. And I think the model has to adapt and grow, or it's not going to be fit for purpose. So I really agree with you on that, Shameran.
And in terms of the things that we need to invest in, I mean, you've talked a little bit about wholesale funding, right? Bangladesh, again, I mean, a lot of things worked for Bangladesh over the years. One was, of course, also the setting up of a wholesale funder that funded the microfinance institutions in a big way. And that, obviously, spurred the growth of the microfinance industry in the 90s. But yeah, in a lot of countries, we don't have good wholesale funding available to MFIs, and that's something you've spoken about. So I don't know whether you want to talk more about that or other things we need to continue to invest in.
Yeah, that's a little bit of an obsession with me, and I don't have an easy answer to it. I do think we need to bring down the cost of wholesale funding. And if you look across Africa, FX is killing both the microfinance industry and the fintech industry. I mean, we've had a bunch of near-death incidents because the Naira tanked or the Kwacha lost value. And so I think we really do need to look at wholesale funding. The problem, particularly in Africa, I mean, India's got all kinds of solutions for wholesale funding, not least because the government's really forcing that issue, but there's a big securitization market. So there's lots of ways that you can raise finance. That's going to be true in Bangladesh too. The average size of an African market is 14 million adults. It's just really small, and every country's got a different currency. And so thinking about solutions that can operate across countries is actually really hard. And you can't have capital markets everywhere. And so I think we have to start getting creative on wholesale funding. But if we can't crack wholesale funding, there's no way we can bring down the cost of microcredit. Your starting point is borrowing at 25%, then, you're going to have to charge a lot, especially if you're in a highly rural country. So I don't have super easy answers, but I think there are things we can look to, right? So, and we're doing some research on this right now to figure out if there's something we can do. But, if you look at how the industry was started in Latin America, there was a lot of wholesale funding provided through Apex facilities with donor involvement, but also channeling funding from the banking industry in those countries. If you look at priority sector lending, same thing. I think in Bangladesh, you guys were able to raise deposits that are relatively low cost without necessarily having those heavy compliance burdens, because they understood that, it was a different animal than a bank, right? And so I think we do have to think pretty hard about how we can get more liquidity into the industry, because it's just not going to grow. And India is such a great case in point. I mean, they are just pouring liquidity into the inclusive finance sector, and guess what? It's growing. So, I think we have to try to think partnerships that made that happen in South Asia and apply some of that in Africa. For some reason, we just all imagined that you would set up these little commercial things that would be banks from the beginning, and they would grow, and it was going to be, easy because it was commercial in Latin America, it was commercial in South Asia. But nobody thought to remember that all those institutions in Latin America and South Asia had a lot of help at the beginning that we never gave to the African microfinance sector. So I think we have to really do some thinking about how we reinvent African microfinance, because right now where we are is a lot of expensive consumer credit that's really easy to access. I don't think that's doing anybody any good.
Yeah, absolutely. I mean, all of those issues. I mean, the FX one is very difficult. I mean, when, for us as well, when we look at sort of, our borrowing, I mean, ideally, obviously, we'd borrow from the country, right? So if we could borrow from the banking sector of the country, that's the best, because then we take away the entire FX issue. But you're absolutely right. Anytime we need to go outside the country, I mean, that becomes the biggest headache. And hedging, it's not even possible in some places, but even where it is, it's so expensive. And the currencies are so volatile that it just drives up costs. And, and yeah, it's just all of these things. I don't know. I'm with you. I don't know what easy solutions there are. But yeah, I mean, in markets where the banking industry also caught on to this quickly and said, we want to lend more to, we want to lend to micro. And a lot of it obviously was driven by, priority sector lending targets. So maybe we need to advocate more for that in certain markets, and show the examples of India and Bangladesh and other places which has done that. But yeah, it's a major issue.
I think there's something about directing the funding to institutions that have the capabilities and the desire to lend to the low-income sector. So if you're a bank and you're thinking about how to put your balance sheet to use, the last place you're going to look is the SME segment and the micro segment, because it's super high cost to reach. The provisioning costs are really high. It's expensive. Like, you're going to lend to the government and go golfing at 3 p.m, right? And so what I think India has done, and other markets have done this too, is they've directed that funding in a regulatory way, basically, to the institution's best place to use it. And what we've seen in markets, I saw this in Peru, right, where banks incorporate micro lenders and have them inside the walls. The logic of banking means that eventually turns into a commercial or a consumer lender, because that's how you lend to people of that profile. Whereas, they got a lot smarter about this in Peru, where, they decided to leave a wall between the bank and the microfinance institution, and they lent wholesale funding to that microfinance institution so that they could reach the kinds of clients they wanted to, because the inevitable logic of banking means that you won't do it. And so I think we have to find ways of building these specialized institutions that really can serve the poor, but giving them the resources they need to be able to do that affordably. And it's not about slapping interest rate caps on. That's not going to solve anything. It's about getting liquidity into those lenders who can do it. Now, those lenders have got to up their game, as we talked about before. We just have to get better at doing this. And that's going to take some digitization, but it's going to take a lot of institutional change management. And, what we've seen and saw at CCAP is there's just huge resistance to that, because you start digitizing and people go, oh, well, maybe we won't have a job. And so there's a lot of reason why, people resist. And so I think there is a big change management aspect that we have to get our arms around, because ultimately, the evidence shows this too, microfinance institutions need to get big so they can offer better terms and conditions to their clients. Interest rates go down the bigger the institutions get, and they become more stable so that when we have crises like a global pandemic, they can ride it out without, risk of near death. And we've seen signs of strain in tier 2 and tier 3 microfinance institutions. So I do think there's a push we need to make to kind of make this sector more robust and more attentive to the needs of its customers.
Yeah, and I want to pick up on one thing you said in your first bit, which was around mobile money accounts most of them being dormant, right? And the fact that, in the last few years, we've hardly moved the needle on that. And yeah, I've got some thoughts on that as well, because, I work a lot with Bcash, and I see how things are going in this market. But just from your perspective, where do you think we're getting stuck?
That's an interesting question. Well, so I think the MNOs, and I'll speak from Africa more because I don't know the Bcash dynamics as well. I think the providers have kind of reached the natural limits of the numbers of people that they can easily sign up. So I think they are turning attention to those usage rates, and I hope that we'll see more on the usage rates going forward. So you're starting to see them have lots of other services run through their platforms. They're thinking of themselves as platforms. So I think the fundamental choices the MNOs are making today are going to kind of define what that industry looks like going forward. And they're kind of taking it in different directions. But I spoke with one of the big operators yesterday, and I was really interested in the direction they're taking. They know that sort of P2P and the transactions-based revenue that they're going to get from that, it's just not going to cover the costs of this business over time. They know that data is going to be a declining revenue stream for them. So they have to think of longer term what they're going to look like. And this particular MNO, it's about building a payment system, and an actual real payment system where you have merchant payments and you have other services that are being done through the platform through open APIs, which we worked with this particular provider on at CGAP. And so what I heard for the first time was an MNO that's thinking more than 3 months beyond today, and thinking about long term what they want that business to look like. And it's easy to kind of trash the MNOs, but to be fair to them, what they've achieved, and same with Bcash in Bangladesh, is phenomenal, because you look at India and China, those two countries were able to leverage big state-owned banking sectors, right? So you had a retail banking footprint that you could already leverage. And, state government has a lot of influence in those markets. That's not true in Pakistan, Bangladesh, in most of Africa. And what the MNOs have done is they've built that distribution footprint. That is phenomenal. And they've signed up all these people. Like, financial inclusion in Africa wouldn't have happened without MNOs. So now I think the trick is kind of deepening that, figuring out what the value proposition is over time, finding those products that are actually going to add value in people's lives. And this is where I think, the open APIs and kind of running the business as a platform where people can, put different services like an app store. That's where you're going to see the kind of experimentation that actually speaks to people and gets them what they want. But one, I think, big problem in Africa is the accessibility of smartphones, because you can't make that work without a smartphone, right? And smartphones are really expensive, but the bigger problem with smartphones is data costs in Africa are just obscenely high. But we're now starting to see the MNOs kind of getting into this and bundling devices with data plans with financing. That's how I got my first mobile phone. That's probably how you got your first mobile phone, right? And so, we're starting to see that kind of innovation wheel that's going to hopefully get smartphones into people's hands. Then we have to help people understand how to use that smartphone, how to connect it with income generating opportunities, because the marketplace has totally changed, right? And so we've got to change with it. So a lot of what we're looking at doing is figuring out how we get smartphones into women's hands, but also how we help them understand how they use that as a tool. And that can get pretty sophisticated, right? If you're playing in the social commerce space, you have to understand your product. You have to understand how to market your product. You have to understand how to do fulfillment and get that product to somebody. You have to have the ability to get payment for that product. And you have to understand how to manage the algorithm so your product is even visible to customers, right? And so, we're asking people to do a lot. And so technology, I think, gives us lots of opportunities that we can really leverage to help the poor earn income. But we've got to run pretty fast to keep up with all the change that's happening. And I think, one of the things that keeps me up at night is the digital divide. Is it going to grow or is it going to close, right? And especially for women. And so we're thinking really hard about not only getting devices in women's hands, but thinking about how we upskill and sort of help women use that to do something more than just check their Facebook page. And so, there's, I think, a lot of work to be done on digital economy and making sure that we're supporting poor customers to deal with the digital economy. And that's a whole new can of worms. So there's lots for us to do.
Yeah, very similar views. First of all, I look at sort of what Bcash has been doing because that's the one I know best. Obviously, cracked the P2P one first and obviously became very big and popular because of that. But that's just people sending money home from Dhaka to the rest of Bangladesh, or sending money from the rest of Bangladesh to a son in Dhaka who goes to university, or a daughter who's studying in college or something. So that was the first few years, and that we built the distribution, scaled the thing, and all of that went well, right? But even if I look at the product development that's happened in the last 5 or 6 years, right? Now there's a lot of stuff that has happened, like mobile top up and merchant payments and utility payments. And things like that, which are all great, and it's added. Now there's a big merchant network in addition to the agent network. You can pay for many things through and then there's sort of back-end bank integration with a whole bunch of banks, so you can pull and push money from your bank accounts into your Bcash accounts and all of that. So all of that is great. But there are a couple of things that I think still see as being problems. One, of course, you mentioned is smartphones. Right? Doing all of this over a USSD platform is still so tedious that you can't do very much. So the smartphone rates and prices are going down. Chinese smartphones are flooding the market. So even if I compare to 5 years ago, you can get much cheaper smartphones. Data is still expensive, as you said, in most countries, right? And as well here, but hopefully becoming more affordable over time. So that problem, I think, in 5 years will definitely be better than now. But given where I come from the financial services space, one of my things is that we don't have the traditional financial products yet, going through mobile money, right? And part of my hypothesis is that most mobile money companies are owned by mobile network operators, right? I mean, almost most, I mean, all 98%, and a few in the world are not, like bKash, which is owned by a bank, but still basically run by, you know, if you look at management staff and the staff that are in bKash, they're coming from either mobile network operators or FMCGs, right? And not coming from the financial services space so much, which is a good thing and a bad thing, of course, right? So, you know, one of the fears we had in the beginning of bKash is we didn't want to fill it with bankers, because we thought it needed to be a very different kind of an institution, which I thought is absolutely the right thing. Because I don't think bKash would have been bKash if we just filled it with a bunch of BRAC bankers moving over to bKash. But on the flip side, people don't understand financial services in that company, right? So they understand what they know from their M&O background, which is airtime top-ups and some merchant payments, and they want to work on all of that and drive a lot of that. But, you know, as soon as you start talking about, you know, are you talking to banks and are you talking to, you know, the MFI industry about how to get their products out much more cheaply and much more quickly to the bKash clients, right? That's harder. That's a harder conversation. And on both, and as you said, on the MFI side, there is resistance. On the bKash side, that's too hard. There are 10 other easier products that I want to work on first. And it's created inertia. It's created, you know, blockages. So I think, you know, and for poor people, a lot of them have opened accounts because they got a one-time payment, or something happened, or they got a kickback, a cash back, or because they opened an account, or, you know, because all of these mobile money companies did that to drive up account opening, right? But then to translate that into account usage for people who don't need the P2P payment and who don't pay electricity bills because they don't even have electricity, or, you know, they don't, I mean, you know, they need a use case. And I think the best use case is savings and credit to begin with, right? And that's not there yet, right? What you have is very expensive emergency credit in some markets, but that's a problem, as you said, consumer credit, very expensive consumer credit, which is quite problematic sometimes. But, you know, beyond that, there isn't a lot going on. And I think we need to crack that as well to drive up usage, right?
Yeah, I think things may start changing. And I'll tell you why I think things might start changing. But I think it presents a bunch of new challenges for us, right? So I think ultimately the brilliant innovation of mobile money has nothing to do with sending money on a phone. I think it has to do with two things. One is distribution, cash in, cash out network. Nobody ever wants to talk about the cash in, cash out network, but mobile money doesn't work without it, because that's how people interact with the system, because most people are in the cash economy. That is fundamental, and you can't run a mobile money business without it. But I think the other big innovation was the float account, where, you know, banks kind of could do the thing that they could do, which is hold large amounts of, and MNOs could do what they do, which is distribution and billing. That's what MNOs do, right? So we kind of cracked that model, and I think it's worked really well. It's all right. It's kind of one-off use cases, and I think importantly, it's distance use cases. It was easy to sort of solve for P2P over a distance, bill pay where you're saving somebody hassle or whatever, but almost entirely distance use cases. I have been working on merchant payments, I don't know, for the last 10 years in Africa. It's like bashing your head against a brick wall, because those face-to-face use cases, cash is still better, right? And so I spent a lot of time on interoperability and trying to get, you know, a brand where you could have kind of the Visa and MasterCard solution. And you know, that is starting to happen. And the other thing the SOTIR report said this year is merchant use case, you know, merchant payments are growing as a use case. And, you know, back to the start of this conversation, we can't expect this stuff to change overnight. It takes time. And you see kind of big step innovations and then little innovations around it that sort of move the ball forward. And I think that's what we're seeing. But I'll tell you, you know, this conversation I had yesterday with an old colleague who's in an MNO is the first time you know, this MNO is looking at taking credit risk. I've never heard of an MNO doing that. They're going to get into the financial services business. Now, that's great because they're big and they can do it, but it's kind of scary too, because you know, we've seen what commercial providers, very commercial providers of financial services do, and it's to charge a lot of money because that's how they kind of cover the cost. So, you know, I think this particular MNO is being quite thoughtful about it, but the commercial logic may lead them in a certain direction, right? And so I think we're about to see another spurt of innovation that's around things like value chain financing and sort of gluing value chains together better than they were before. You see a lot of this in Kenya, for example. It's going to involve embedded finance, where you're doing something else and you can kind of get financial services through that. We see that a lot in things like social commerce, gig work. It's going to involve these API platforms where lots of people can run services over, a super app, and it's just a way of aggregating those services. I think that's all great because it gives consumers more choice. There are more options. You get those use cases out there, but I think there are also risks around it, right? And primarily consumer protection risks. So as you think about, getting credit into marketplaces, what are the risks that's placing on consumers? What are we charging for that credit? Do consumers even know they're getting that credit? I had this really eye-opening conversation with a colleague from India a couple of years ago who, she's in the financial services business. She understands this really well. And she said to me, I only found out that I defaulted on a credit through Amazon when I got a default notice that I was past due in payments. I didn't even know I'd taken a credit. I just thought I bought something on Amazon. And so, I think there are real risks around some of these emerging models, and these aren't regulated in the same way that you guys are. And we really need to think about that. Plus, I think, the microfinance sector needs to think about its value proposition to clients. I think what a lot of women want is a safe place to save money and a safe place to send payments from. But it's really hard to do that if you don't have a credit business helping make that business model work. And so I think there's still a lot of work to do to figure out not only what products and services people really want and need, but how to make sure that those are getting delivered responsibly and are actually benefiting people instead of doing harm. And this is where I think the microcredit industry, to its credit, has done a lot of hard work, having had, a few bruises over the years, right? But it's got to translate that model and that learning and sensibility into a digital world that is just exploding. And so, I think I used to say at CGAP, we can't do, we got all excited about digital credit. And then 2 years later, we started doing consumer protection on digital credit. It's we've got to do it at the same time. We've got to build those consumer protections into those new business models from the get-go, because it's hard to go backwards on it. And so I think there's a ton, as we get more financial services into the marketplace, there's a ton we need to do on consumer protection and just treating consumers fairly.
Yeah, very quickly. I know we're probably starting to run out of time, but very quickly on that one about savings. I had a very interesting experience towards the beginning of bKash, and I wrote about this a few years ago, but I'll tell the story very quickly. We were really worried from the microfinance side when we were setting up bKash that bKash was going to cannibalize all our savings, right? Because as soon as you can save on your phone, why would you come and save with an MFI? So we had all of these, these doom and gloom scenarios that we created. And then we realized bKash came around, a few years went by, and of course it did cannibalize our savings. And we tried to find out why that was. And we realized that actually, as you said, a lot of the times the women are trying to protect the savings from the male members of their family, which is one of the biggest needs in terms of women trying to save money, right? They don't want the husband going and gambling it away, or a brother going and starting off some business that then fails and everything. So, with the MFIs, they had that. They could park the money with the MFI and tell the drunk husband or the brother or whatever, the son, I've put it with the MFI, I can't get access to it. I need to go and make an application to the branch manager, and the branch manager is gonna, ask what I'm gonna do with it. And that kind of protected that money from the male members of the family. And they were like, now I'm just gonna put it on my phone, and my husband is gonna grab my phone, and he knows my PIN number, or it's his phone to begin with, right? And I'm gonna put all my savings there. Are you nuts, right? I mean, but one of the things that this does, which that doesn't, is it's much more convenient. You can access it much more quickly and easily when you need it. So how can we get that safety and this convenience and marry the two things is, what we've been trying to crack for the last few years, right? So, yeah, it's an interesting one. Once you start realizing the use cases and what the drivers are, it challenges a lot of things you thought you understood. But yeah, anyway, so lastly, so would it be safe to say that you're optimistic about the next few years, and are we trending in the right direction?
Yeah, I think so. I mean, I'm always pretty optimistic. I think looking back, we've made a lot of progress, but we still have a lot more to go. And in a way, it's the same problem as the MNOs have. The faster they sign people up, the faster they have to do, usage and get people using. And I think we're in the same space, right? Because technology is changing both financial services and marketplaces so quickly. We just have more to do. Like, we weren't that worried. We all thought smartphones were going to be amazing, and I can't wait till they come 10 years ago. I mean, we've been talking about smartphones for a long time, right? Now there may be a reality. So then, okay, what do we do with that? That's going to open up a whole new set of things that we have to do. So I think we're just always running to catch up with the technological change and make sure that it works for poor people. But the fact that it's happening is great. I think that the challenge for all of us is thinking about how we internalize it into our own businesses and not try to be, M-Pesa, but try to be XMFI and provide that service in a way that's really meaningful. And so, I think there's still lots of really exciting stuff to do. And we haven't even touched on all the great work that BRAC does to provide kind of wraparound services to people, just helping them, gain capabilities and gain access to social services and get assets. I mean, I think that's all really important stuff with the populations that we're working with. So I think public-private partnerships, especially as we come out of this pandemic, are going to be really important to making sure that people kind of emerge from this crazy time into something that's better, where they can sort of get on that ladder and start climbing out of poverty. So, I think we have all the tools. It's just a question of how we put them together and try to really make it work for the poor. So, and especially for women.
Yeah, absolutely. And one other thing I would say is, if there's one thing that this pandemic taught me, in terms of, the way people interact with financial services, I think our clients are readier than we are, right? We do spend a lot of time talking about, financial literacy and safeguarding clients and making sure that they don't fall victim to, predatory, services, predatory things. And, and of course, there is work to be done there, for sure, right? These are vulnerable people, and they can very easily be made, cheated and things like that. So there is work to be done. That's where regulators and things come in. That's where, responsible institutions have to do their part. But my sense is that poor people, and even, especially poor women, are ready to take on and use these services in a way that we can't even necessarily imagine. So I think they are way readier than we are, and we've got to get our act together and get things in place because they're ready. I think we're failing them at this point, is what I would say. And the pandemic proves that, because the moment we rolled things out, there was such an uptake for digital financials, because, we couldn't go out and do things in the normal way. And we thought, oh my God, we were going to very slowly do this over many years, because we thought we had to do a lot of handholding. But, they didn't need all that, right?
I love that idea, because I think it's too easy to fall into this idea that we're somehow here to save people and make people's lives better. I actually think if you give people tools, they will make use of those tools. And I have a lot of faith in the ingenuity of poor people in emerging markets. People just need a little bit of resource to be able to achieve their full potential. And the shame of poverty is that we're not letting people achieve their full potential. Think of all the value and innovation we're missing out on, because people don't have those resources. So I really agree with that. And especially women, like, let's remember, for women, it's even harder. So, and we're missing out on all that women could do. So
that's the main thing. If 50 years of BRAC has taught us anything, you put tools in the hands of women, and you don't have to worry too much, because women are, they invest in the right things. They're responsible. They don't go and spend money in the wrong way. I mean, some do, but it's a small number compared to, most women who, with the right tools, just do so well with it. It's incredible. So
women get stuff done.
Yeah.
Yeah.
Yeah, I think keeping that top of mind and trying to solve this for them is the most important thing for us. But hopefully we can supercharge this and do better than we've done in the last few years. This has been great, Greta. It was great to chat to you.
As always, it's a pleasure exchanging views with you. Thank you so much for having me.
Thank you very much. And look forward to seeing you in person, hopefully later this year when we do this in person.
I hope so. I'm hoping for an invite.
Great. Thank you.
Okay. See you soon.